Welcome to the Simply Safe Dividends channel. I'm your host, Brian Bollinger. If you want to retire, you have to solve the problem of separating your income from your time, or at least be willing to get creative with a style of living that some people might find to be a little less than desirable. The good news is you don't have to live on a cruise ship to generate passive income in retirement. There are actually many ways to separate money from time to stop working and be ready for your golden years. Everything from pensions and annuities to Social Security payments, rental income, and withdrawals from a portfolio of stocks and bonds. Chances are you'll lean on several of these passive income sources, and in today's video, I'm going to show you how a simple dividend investing strategy can serve as a foundation to provide predictable and growing income in retirement while giving you peace of mind that you won't run out of money. Now, I'm not retired and I won't be anytime soon, as my wife and I are expecting our fourth child this fall. But I have worked in the investment industry for nearly 15 years and seen firsthand how many investors have relied on dividends to attain financial freedom and avoid needing to drain their assets to pay their bills. Here's an email one of our members sent me a few years ago. Jeff retired in 2018 and decided to manage his own portfolio using Simply Safe Dividends to avoid paying fees to an advisor and pick dividend stocks that aligned with his goals. By relying on dividends to make ends meet, he's funded his retirement without having to sell off parts of his portfolio. He just sits back, collects regular dividend payments in his account, and no longer lives and dies on the ups and downs of the market. That's a big advantage of dividends compared to a traditional withdrawal strategy where you have to figure out how much of your stock and bond portfolio you can safely sell off each year to create income. If you sell too much, you risk running out of money, especially if a bear market takes place in the early years of retirement. The standard 4% withdrawal rule can also feel a little risky today due to high stock market valuations, which lower future returns, and high inflation, which might force you to withdraw more money than you had planned for down the road. Dividend investing can relieve many of these anxieties, which you'll see here by looking at healthcare giant Johnson & Johnson. I plotted the company's quarterly dividend payments in orange and its stock price in blue going all the way back to 1999. Even though J&J is one of the more predictable businesses in the market due to its large size and recession-proof products, its stock price still declined by around 40% during the financial crisis and has gone through other stretches of stagnation or decline. Those would be stressful periods to navigate if you were relying on a withdrawal method in retirement, but none of that noise mattered for the dividend since that is paid out of the company's steady cash flow rather than driven by the market's unpredictable mood. Seeing dividend payments hit your account during downturns can make it easier to stay the course, especially when those payouts are regularly increased like J&J has done every year for more than 6 decades. Unlike CDs and bonds, which make fixed payments, most dividend stocks grow their payouts over time, and J&J's dividend has compounded by about 8% annually over the last 20 years, which is well above the rate of inflation. To put it another way, if you bought 100 shares of J&J in 2004, your annual income from this position would have increased from about $110 in the first year to nearly $500 today, all without buying more shares. You just had to sit there and hold. Stock prices follow earnings and dividends over time as well. So this investment would have also more than tripled in value, going from around $50 per share in 2004 to over $150 today. Since you kept all your shares of this income strategy, you more than preserved your capital and could be in a spot to make a generous gift to your heirs, or at least enjoy some cruises without having to call the ship your home. Now, I'm not trying to cherry pick by showing only one stock's success, since the reality is Johnson & Johnson is far from an isolated example. Using Simply Safe Dividend Stock Screener, I can filter to look only at companies that have raised their dividends each year for at least a decade. You can see that hundreds of stocks qualify, and a lot of them even have dividend yields well above 5%. After selecting 30 dividend growth stocks and funds, I used our portfolio tracker to put together a $1 million portfolio of these securities to show you a practical example of how this strategy works. There's nothing fancy here. You can see I've included mostly blue chip stocks like Chevron, Home Depot, and Coca-Cola, as well as Schwab's popular dividend ETF SCHD, which accounts for 10% of the portfolio. Each remaining position was given a roughly 3% weight. This simple retirement portfolio is on track to pay us around $41,000 of dividend income in the year ahead, which represents an initial yield of 4.1% on our money. That's not too different from the typical 4% rate used in many withdrawal strategies, but this is where most of the similarities end. All of your shares remain in your portfolio after you receive each dividend payment, and as our income calendar report shows, you know exactly when and how much you are getting paid without worrying where the money will come from or what the market will do. I can see where our $41,000 of annual income is coming from by month and by each dividend paying stock and fund I hold, since they declare regular payouts with pre-established dates and amounts, typically 1 quarter at a time. You can see that in our portfolio's past payments tab here, which shows cash dividends that would have recently hit our account. One of the beauties of a dividend growth strategy is that this income stream rises over time as our companies find ways to increase their profits and return some of those additional earnings to shareholders in the form of dividends. Our portfolio's dividend growth report shows how our portfolio's passive income stream would have changed over the past decade based solely on how our positions grew their dividends over time. The portfolio I put together has seen its dividends grow by around 6% annually over the past decade, and that's again without contributing any additional money or reinvesting the dividends back into more shares. We had all sorts of market environments during this time, including a pandemic, but none of that stopped this portfolio's income from marching up from around $20,000 in 2014 to more than $40,000 today, which far outpaced the rate of inflation to protect our purchasing power. The income forecast report can give us a sense for where our portfolio's dividend stream could go in the years ahead. Since this is a retirement portfolio, I'm going to assume that dividends are taken as cash rather than reinvested, and that we do not make any additional contributions to the portfolio. If we extrapolate our portfolio's 5-year dividend growth rate into the future, we can see that our annual income stream could rise from $41,000 today to $54,000 in 5 years and $125,000 in 20 years, all without having to sell any shares or contribute more money to the strategy. And once this type of conservative portfolio is in place, very minimal trading is required. To give you an example, I've managed 3 model dividend portfolios since 2015. I'm a conservative buy and hold investor, so we've averaged only 1 to 2 trades per portfolio per year, since as long as the dividends continue looking safe, there's little work to do. This simple approach has resulted in healthy total returns and dividend income growth each year for each portfolio. But what's the catch? What are the common pitfalls to this strategy? The biggest mistake I see dividend investors make is chasing yield. There's a great temptation to buy stocks and funds that might yield 6, 8, 10% or higher. The bigger the yield, the more income in your portfolio, and the sooner you think you can retire, but only if that income is safe. At Simply Safe Dividends, we help you manage this risk with our dividend safety scores, which are highlighted at the top of every company's page and found across pretty much all of our site. Our scores fall across a 0 to 100 scale, with companies scoring at least 61 points considered to have safe dividends that are at low risk of being cut. Of the 800 plus cuts we've seen in real time since we started doing this in 2015, investors would have avoided over 97% of the cuts if they stuck with companies that kept safe and very safe ratings. Now, chasing yield usually means you are buying risky stocks with poor dividend safety scores, unreliable income streams, and weak long-term total returns. Your portfolio is also likely to be concentrated in just a few high-yielding areas of the market, like REITs, MLPs, business development companies, and closed-end funds. There's nothing wrong with owning some high-income plays, but making them your entire portfolio can lead to problems, since some of these subsectors usually get hit hard during recessions or are very sensitive to factors outside of their control, like interest rates. I advocate for a balanced approach that includes some high-yielding stocks, but many others that might only yield 2 or 3%, but a very strong dividend growth to give our portfolio's overall income stream a nice lift over time. At the end of the day, I think it's hard to build a conservative dividend growth portfolio that yields more than 3.5% to 4.5% without beginning to sacrifice on business quality, income safety, or diversification unless you are targeting a much shorter time horizon than the traditional 30-year retirement planning window. This rule of thumb can help you figure out how much money you need to retire. Ignoring potential tax effects, you can essentially multiply your desired annual expenditures that need to be met by dividends by 22 and by 28 to establish a reasonable range for how big of a portfolio you need to live off dividends. For example, if you needed $50,000 each year from dividends, you'd need a portfolio between $1.1 million and $1.4 million. Ultimately, there are no magic income sources or hacks to retire with a lot less money unless you're willing to live frugally or take on more risk. At the end of the day, I think dividend growth investing provides some unique benefits compared to other passive income strategies, but just because a company pays a dividend doesn't mean it's a superior investment or resistant to price drops in the broader stock market. In theory, whether your retirement cash flow comes from dividend income, bonds, or sales of your portfolio's holdings shouldn't really matter, but I'm obviously biased towards a dividend-centric approach because this strategy makes it easier for investors to stay the course during downturns by seeing regular passive income continue to trickle in. It also provides consistent income growth, which really adds up over time, and if the stock market experiences a major correction in the early years of retirement, dividend investors have less exposure to sequence of returns risk, as they do not need to sell more shares in response to lower stock prices as long as their income stream remains secure. There's a lot more I could talk about on this topic, but I hope this video gave you at least a high-level understanding of how dividends can serve as a stable and growing passive income stream in retirement. If you enjoyed this video, it would really help me out if you hit the like button and considered subscribing to our channel, which will stay focused on sharing different dividend ideas and stock analysis, as well as practical investing tips for this strategy. You might also want to check out our website, Simply Safe Dividends, which is free to try and can help you keep your retirement portfolio between the guardrails with things like our portfolio tracker, dividend safety scores, dividend stock research, our screener, our newsletter, and a lot more there. Thanks again for watching, and I hope to catch you next time.